Welcome, everyone. Today we've got the fourth webinar in our advisory webinar series, and I'll hand it over to Matt right now and take it away.
Thank you, Kylie. Thanks for all the work you and Cy and the team putting this together. I appreciate it. Today we are here with Brock Vandenberg, who is the president owner of Talamar Financial, a client of ours and someone we've known for quite a while. Brock, welcome to the webinar.
Well, hey Matt, thanks for inviting me on. I'm excited to be with you today.
Of course. Brock and I just spent a little time together down at the California Mortgage Association event last week in Indian Wells, California. It was good to see you down there and good to be a part
on behalf of the
it.
California Mortgage Association, I really appreciate Verivest being a sponsor and attending. We're excited to have you on board.
Yeah, Brock's a big participant and champion and board member at CMA and done a great job of promoting that organization. And for any of you lenders out there in California, it's a great organization with lots of good value. So something you may talk to Brock or others over there about. So,
well, thank you.
But we want to have, we wanted to have Brock on the show today. Brock's a good client of ours. We've known each other for quite a while. I think Brock's a great case study of someone who has successfully been able to go out and start and launch a fund and really grow and scale it well, which in my experience, and I've done many of these, hundreds of them over the years, not everybody certainly can get to that level of success. So I thought it'd be a good story for people to hear and kind of go through the whole thing. So Brock, I'd love to maybe start back in the beginning, not all the way in the beginning, but you know what I mean, in terms of like how you kind of got into business, a little bit about your background, and then we'll kind of work our way to your transition to the fund.
Yeah, sure thing, Matt. Honestly, I kind of fell into the private lending industry prior to launching Talamar Financial. And to give you a background, Talamar Financial is a private lender. We specialize in financing residential and commercial bridge loans, so fix and flip loans, bridge loans, and new construction loans. And so I was in the private equity industry from about 2001 to about 2007 doing what's called mezzanine debt and JV equity. So essentially came in as a capital partner for large private home builders. 2007 hit, the company I was with decided to exit that investment strategy. And I kind of found myself not knowing where my next step was. Actually spent 2 years with the FDIC helping shut down banks, but that wasn't a long-term play for me. I randomly went to an real estate investor event, met up with a gentleman that was buying foreclosures at bank sales and then foreclosure sales as well. And he had the expertise, the knowledge of buying these properties, renovating them and selling them. And this was really early on in that fix and flip business. And what I had done is I had saved money from my prior career. And so I started just lending him money. He'd go out and lend him money, and he'd go out and buy the properity and pay me back in 2 or 3 months. And these were
what time frame is this? This is coming out of
this was probably about 2010 is when this started all happening. It was about 2010.
Yeah.
And, I did a couple, it all worked out. I got repaid. I had some friends and family that were interested in investing alongside me. For those not familiar with the term, it's called trust deed investing. Essentially, you're lending money to an individual, just like a bank. And then you would begin to fractionalize these notes. So at first the loans were 100,000 and 200,000 maybe, and I could lend that money out with my own cash. And then I started bringing in investors in. Instead of lending out 200 of my own money, maybe I'd do 100 and then fractionalize that out with another investor for another 100. And that was actually the catalyst to get us to where we are today, because it was a great kind of platform to raise money. So as I did more and more loans, I started doing more and more fractional notes, and people started to invest more and more money with these notes that I was originating. I would market the opportunity out to a handful of investors. They would then bring their friends and family in themselves and invest in these notes. So fast forward, go ahead.
Well, to dig in a little bit deeper on that, so fractionalizing the individual notes, these were all single individual trust deeds. So for example, just hypothetically, if you did $1 million loan, you might have 8 investors, and somebody put in 200, somebody puts in 50, somebody puts in 75, totaling up to $1 million. But they each own a piece of that one individual loans. So for you as the person originating that loan, right, you have to go out each time, and for each individual loan, you have to market that loan, right, and have people come in. And so how long did you do that, and how many of those would you say that you did?
So we were probably in exactly what you talked about is the reason we jumped to the fund structure. But so by the time we launched the fund, we probably funded over 400, maybe 450 million in loans. We
Wow.
had maybe 40 loans on the books, and with an average of, I would say, about 4 to 5 investors per loan. So you
Yeah.
can imagine the complexity of managing a portfolio of individual loans, with each loan with 4 separate investors, trying to communicate to the investor on every one of those loans.
Yeah. Yeah, I'm very familiar with that, and that becomes challenging. So at some point, then walk us through kind of the thought process that you went through to decide about a fund. You heard about it somewhere,
Mm-hmm.
you did some research, like how did that all come about?
Yeah, so what happened was we kind of created a nifty platform where we would send out an offering for an investment, and you kind of hit it. It started, these loans were, when I first started, were maybe 200,000, but by the time we hit 2020, and we had to make that jump, you're talking loans of $1 million, and most investors are good for maybe 100 to 200,000. So you're having to aggregate more investors per loan. But essentially, we would shoot an email out and we'd say, okay, investors, this is what we have. Who wants to invest? And it would be subscribed in minutes. And I had investors calling me up saying, Brock, this is, you can't do this to us. I am a long-term investor. You have to let me in on this offering. And it just became a very difficult, the communication became difficult with investors. And that really right there was kind of that catalyst that said, okay, we got to look for a better way to bring in our investors. We're really limited to the number of loans we can do, because you can only just manage a loan portfolio that's so big with so many investors. And we wanted to scale. I mean, this was a great platform to start with, but we needed to find a better way to scale, but then create a more efficient process for our investors to participate in this offering. So went to another plug here, a couple California Mortgage Association meetings, and started talking to other fund managers. I think the biggest hesitation for me was that, I had this perception that launching a fund was like overly complicated. It was for New York banks. It was something that, a lender from, San Diego isn't going to be able to manage or do. I mean, we talk about, new platform for accounting, having the right team, having the right software. Where do you even begin? But that's when we started having those conversations and saying, okay, this fund structure is doable. There are the right players out there that you can align yourself with to ensure that can increase the percentage chance that it's going to be successful. And so about 2020 is when we finally said, okay, investors, we've decided to shift our platform to this mortgage fund structure.
Yeah, let's talk about that. I know that has been for, I've got as people may or may not know, I mean, I've run a number of debt funds myself over the years. That's kind of what got us in this business. We've helped hundreds of managers set up and run their own fund and do the admin for them. So I'm extremely familiar with kind of the narrative and the arc of Brock's story, not just with Brock, but with lots of other people. My experience in that whole time, Brock, has been that it can be challenging to make the leap in terms of a number of things, but not the least of which is the switch from the investors being able to pick and choose which deal they go into specifically, and coming into a fund where they don't get to choose the individual deals, but they're part of, they own an ownership share of an entity that owns the loans that they don't get to pick and choose. Well, what was your experience with the transition and the capital raise side from the former to the latter?
Yeah, man, I would agree with you. I think right away when I started having conversations with some of our larger investors, there was some hesitation there. They liked this idea that they could select the loans, and it was working. And it goes to the mantra of, if it's working, why change it? If it's not, why fix it? So, but I, in further conversations, in talking to them and saying like, look, you're missing out. You've got capital on the sideline that's not invested. It's not invested because I can't get it efficiently invested for you. we're not changing any of our underwriting guidelines or our target markets in any way. We're just providing a more efficient and actually tax advantageous way of investing in these mortgages. Again, I mean, the pushback was there. And, when I launched this fund and you pay a lot of money for the paperwork and getting this thing started, it was, a big risk. But I think at the end, when I look back, it was the best decision that I made.
Give us a sense of the arc. Like, so you started it, when you launched in, you said what, 2020 or 2021?
2021. Yeah.
And so like how, I mean, I think you're at somewhere around 100 million today,
Yep.
right? So how, like, give us a sense of like what the growth was over that time period.
So, one of the things that I think really helped us is that we did have that track record of investing in individual trustees, and I was able to market to those investors pretty early. And then I remember when I got beyond me being the first investor in the fund, I was actually at an American AAPL conference when we got our first subscription. We got our first investment for 100,000, and I stood up in the middle of this meeting and started clapping.
Yeah.
I was sitting down there with a couple other lenders out of Texas, and you know what I find, and I'll kind of going off base here, Matt, take me for a sec, but if you go to these events and you kind of tell other lenders what you're doing, it's a really open community out there. People talking about kind of best practices. If I can pick up the phone and talk to another lender, and competition aside, I mean, they're going to give you some insights. Matt, when you came down to our office about 2 months ago, I mean, it was extremely insightful to just kind of hear your story and your experiences so that I can apply that to our growth trajectory. So to get to the point of the story was I was sitting down with another lender and he said, Brock, the one thing I did learn was that when you commit to moving to a mortgage fund, you have to commit. There's not this, hey, I'm going to have half my investors and trustees and half my investors in the mortgage fund, and that's how we're going to operate. No, you're going to commit and you're going to move those investors to the mortgage fund, or you're just not going to be able to service them. Because what I found running, and I'm getting ahead of ourselves here, but running a mortgage fund is very different than investing in running a trustee platform. They're two separate companies. Even your lending company becomes a separate company than your investment company.
Yeah. So to that point, did you continue to, I tell people, like, sometimes you're doing 100% fractional and 0% funds. You don't really just go like this day one. Did you do some deals continuing like that?
I mean, there was a point. I got to keep the business moving and the lights on. So, there was this this kind of change up, but it happened really quick. And I was, one of the things I did in our email distributions is say, hey, the fund will always have first right of refusal on loans that come to our shop. And it did. And people started to take notice. Some people were, frustrated. Well, hey, that's not fair. And you said, well, look, I'm offering what I feel is a better option investor for you to invest. And, they did finally come over. And we still have legacy trustees that we had funded in our platform. But what we're finding is that as those loans pay off, then they invest in the mortgage fund. And it's not just our platform that they, as trustees, pay off. They've been investing with other groups. And as those loans pay off, they just move them into the mortgage fund.
Yeah, well, that's good performance, good marketing, good communication, et cetera. You said something there that I want to prod on a little bit too, is that the idea of running a fund it's a business unto itself, right? And I think a lot of people, in my experience, they underestimate what that's going to be like. What has been some of the issues, challenges, things that are different about the fund, maybe that you didn't anticipate that fall into that category?
So I know what my strengths are and what my weaknesses are. My strengths are I like originating loans. I feel like I'm good at underwriting loans. I'm good at managing a loan portfolio. What I'm not good is accounting. And I know that. And again, this is not just a plug for Verivest or something, but I appreciate
the plug, but it's true.
I just know what I'm not good at. And then also what I was really concerned about was all the regulations around running a mortgage fund, because I mean, it's big. There's a lot out there that you have to know. And there's no way for any individual fund manager just walking into the industry that you could even begin to understand what the rules and the regulations are around you. You're working, here in California, you're working with completely different governmental agencies to submit reports and provide guidance and whatnot. So that I was able to kind of outsource those functions and still remain focused on originating, doing what I think I could do well. Now, what some of the big changes in talking about two companies is that after a certain point, you're going to have to hire a investor relations person. So somebody who's just dedicated to communicating with investors. It could be someone that's just out of college and they're just processing paperwork, to somebody who may be pitching investors. Depends on kind of where your comfort level is. We were able to kind of create processes and procedures more to bring somebody in and just do the paperwork and whatnot. But what we found happened was your investor relations person, where trustees, they're kind of all correlated, because the person that's doing the investor relations kind of needs to know about the loan that they're pitching and all the details and information. But with a mortgage fund, this investor doesn't necessarily see the individual loans in the portfolio. So that was kind of a big change in what we have to do is continually update and let our investor relations person know what's going on the loan origination side.
Yeah, and while we're continuing the conversation, if anybody has questions you want to, Kylie, what we want to type it in the chat box or the Q&A box, please feel free to do that, and we'll get to questions here either along the way if they're relevant to what we're talking about, or at the end. So please feel free to do that. Yeah. So Brock, you talked about, and I very appreciate the plug for Verivest, and I find the reason we really even have the business is that that's very true across the board, is that, and it really doesn't even apply specifically or only to private lenders. It's really true with all fund managers. Generally speaking, their strengths lie in the deals, finding the deals, underwriting the deals, working the deals. That's what they're good at. That's what they like. That's what they got into the business for in the first place. And they become, over time, good at raising capital, because you have to be, because that's the lifeblood of being able to execute the business. There's lots of other things that you need to do well, which includes accounting, especially in a pooled fund format and so forth. What are some of the other things that you have structured your business? Because I find there's OpCo and there's FundCo, and there's things that you need to have in-house, and there's things that you can outsource. Right? What are some of the things that you believe that's worked for you in terms of what you have functionality internally and functionality that you outsource to other people, not just admin?
Yeah. So right on the front end, align yourself with a good attorney that is going to draft a good set of fund documents. Don't go with the cheapest attorney. I didn't make that mistake. That someone told me right away, was to go with this, a group that specializes in putting fund formation documents together, whatever the instrument that you're putting together, if it's debt, if it's equity, what have you. But find a good person and talk to a lot of other fund managers out there. I mentioned that a lot of people are willing to share tidbits of information about running a fund. Go talk to fund managers and get their feedback on certain vendors and whatnot, and who they recommend going to. So that's number one, because out of the gate, if you're on the wrong horse, it's not going to work for you. Now, in the fund industry, or in the debt industry, we've partnered with another loan servicing company by the name of FCI Lender Services, who provides just ongoing loan servicing support. So we also felt that from a servicing standpoint, especially here in California with the regulations, there was just no way that we wanted to focus and manage on that. So I'd have to hire a team. I'd have to buy the software, incoming checks and accounting. That's just something that we decided to outsource. Same thing I kind of mentioned with the accounting and investor management as well. There's just not something that I could hire on, because I didn't have that background. And in the accounting, there was no way that we were going to hire somebody to come in and do the accounting.
Yeah. How about like audits? Do you guys do audits on the fund? Do you have a third-party auditor and CPA and all that?
Yeah. So from an audit standpoint, we've outsourced the audit too. That's something that a lot of our investors have asked for. I don't know if they look at it in detail.
No, they just like to know that it's there.
they like to know the audit is there, but who likes to look at it in detail is going to be your capital partner, so your bank. So we have credit lines, and that's a requirement for a credit line for their debt fund.
Yeah, so you use is it a borrowing base or like a warehouse line? Do you use that to increase the yields to the investors, or do you use it for cash management purposes, or both, or what?
No, Matt. Yeah, so I'd say we're more on the conservative end. We simply use the credit line for cash flow purposes. So if we find ourselves lying on cash, we want to close a number of loans, we'll draw from that credit line, fund those loans, and then quickly pay that credit line off. I had the opportunity to when I first started in the private lending industry, I happenstance subleased space from another private fund that actually had gone down during the 2007-8 crisis. And I sat down with that fund manager, and they were extremely leveraged. And he ingrained in my brain that be careful with leverage. It can be a two-edged sword. It can work really well for you, but it can be lights out for you as well. And so I just decided to take a kind of more conservative approach at utilizing credit.
Yeah. So as you look forward, Brock, so you've gone, and I think we can get the basic trajectory. You launched in 2021. Here we are in 2025. You're at about 100 million.
Yeah.
Where do you see over the next 2 or 3 years your business going?
So yeah, I'm sorry. I know you asked kind of what that trajectory looked like. So I think within the first year we had about 10 million. Second year, I think we got about up to 30 million. Third year into it, we were at around 65 million. And then up to now, we're at that 105 million mark. And so I would say that the tipping point, and I don't, people, when I talk to fund managers, like the third year is kind of your breakout year. And it did. For our third year, it was kind of our breakout year where I spent less time doing capital raising, talking to investors, marketing and whatnot, where it kind of hit that tipping point where now the money just kind of, comes in, the subscription agreements start to come in. I had mentioned, Matt, earlier today that we're really seeing the capital flow in now with what you're seeing in the equity markets. So you're seeing a lot of people kind of shifting their investments more into a fixed income investment. But it was like that third year. And again, I can't pinpoint why. It was just the third year. Maybe people wanted to see 3 years of experience for a fund manager. And that's when they feel comfortable that they had the operations in place.
So let's talk about a little bit about that on the capital raising side. And we touched upon it earlier, but what have you done in terms of raising capital? Do you outsource that to other people? You do it all internally? Do you have somebody dedicated internally to doing it? You have an IR person? Like, what does your capital raise, apparatus infrastructure look like?
Yeah. So, I've talked to other fund managers, and I think to have somebody, I'm sorry, I got a call coming in here. I'm going to unload that. What I found was that,
Popular guy.
Yeah, no, I forgot how to turn all my calls off here. So what I found, or when in speaking to other investment managers is you got to kind of be the face of the company at the front end. So they're going to invest in, obviously you're going to have a good investment that for people to invest in, but they want to see who the fund manager is and get comfortable with the fund manager from a trust standpoint. And then obviously with that, you're aligning the investment opportunity. You're talking about the history, the opportunity. And so I'd say from a trust standpoint, that's why I wanted to be in front of the investors.
Yeah. I find that that's absolutely true across the board for managers, is that the main person needs to be that, but you also need somebody, because you have so many other responsibilities going on that doesn't allow you to focus 100% of your time on that. Do you have what support services, or do you have to be able to do that that's helped you get where you are?
So the support services that I have here I've got a full-time investor relations person that assists me in drafting out all the investor documents and whatnot. So once we've had that initial conversation with the investor, then I can hand over that investor over to our investor relations person to draft out the subscription agreement, to do the accreditation and whatnot. So the physical stuff I can put a process in, but I still get on the phone. Even we're 150 million, or I'm sorry, 105 million with about 300. I think we're about 30 investors now. Most cases I'm still on the initial call with the investor, talking about the investment, talking about my experience, talking about the performance of the mortgage fund. And the other thing that I'll say is that we rely heavily on stuff like YouTube and other social media platforms to educate investors about the investment. So by the time an investor gets on the phone with me, they've already made the decision to invest or not. They've already seen the YouTube videos the educational YouTube videos. And again, I want to say educational because it's not a pitch video in any way. It's just educating people on the industry. They've already watched those, so they get back on the phone with me. They want to just hear that, that they've got a live body on the phone. Maybe they've got some general questions that they want to go through, process questions and whatnot, but get comfortable with who I am as a fund manager. And the call is typically 15, maybe 20 minutes with the investor at that point. But in terms of like infrastructure, so we have a full-time investor relations person. We have a CRM that kind of manages our contacts. But then we rely heavily on Verivest platform to physically manage the investor. So, if they got questions about their balances or whatnot, we can quickly log in, look accounts, and answer any questions that the investor has.
Yeah. Yeah, I think that there's a lot of misconceptions out there about how to raise capital, and you guys seem to have done a fantastic job, internally of doing that. I think that's probably the single biggest impediment, I think, for most people to figure out how to scale. Do you see the constraint going forward for you being more on the capital side or on the deal side, or what is that balance? Because that's it's like I would say it's like an apothecary scale. You got to have both, and they got to be reasonably in balance, or else it just doesn't work.
So I would say, Matt, it's the day you call me, the day you talk. Yeah. So like right now, we're probably a little more weighted on the capital or investment in the capital side than we have loans.
Yeah.
So you have to balance out.
Exactly.
We've got a lot of key performance indicators that we look at. I know how many loans that we do on an average month. I know kind of an estimate of turn on our loan portfolio. So I have a good estimation of how much money I have to raise in a given month. Usually that's about 3 to 5 million a month that at this point that we're raising. But if we find that we're just too weighted towards investor capital, you just start to build a queue, and as you need the money, you'll contact those investors.
Yeah, and in your business, in the mortgage space especially, right, these are relatively short-term loans. So when they pay off, you can recycle the capital, right? This is an open-ended fund structure that you can, then money comes back in, you distribute the income, but you're reinvesting the principal. Is that right? So that mitigates the amount that you have to raise depending on how many payoffs you have coming in.
So I think, I would say, if I were to compare like a capital raise to an equity fund where you may be taking down a multifamily property, or commercial property, where it's kind of like very quick, you need to raise the money quick, and then you're kind of at a lull here. Doing a debt fund is just a constant. You kind of want to keep it between whatever your comfort level is in terms of the loan originations that you're doing. And I think maybe that's, that offers a little more ease in raising money, and the liquidity, obviously, as that funds can seize up if the market closes out and you can't do withdrawals and redemptions. But because you have turns in loans, redemptions are a little easier to manage.
Yeah, I find that mortgage pools everything has its trade-offs, pluses and minuses, but mortgage pools, in that way, you can raise the money and be making loans at the same time. If you're buying big properties that require huge equity checks, it can be a little tougher. It's a totally different fund structure, et cetera. So, all right, as we get to the bottom of the hour here, let's go with a couple of questions I have here, Brock, and I'll throw them out to you, and I can maybe handle some of them as well. But here's one about someone's got a fund from they're about 5 million. They're looking to scale it up to as much as 25 million, and current strategy, among others, is reaching out to wealth managers and RIAs as strategic relationships. He's going to an ADISA conference. I forget what that stands for, but it's a broker dealer. Basically, these are professional capital raisers. Conference in a couple of weeks. Any advice how to position ourselves in our fund They're so often required by FINRA broker-dealer beyond platform. Any recommendations? Have you dealt much with RIAs and broker-dealers, Brock, or?
No, I had this idea last year that we were going to do it, spend some money marketing to them, scheduling some meetings, and I honestly I did not have very much success with it. Now that's probably just our approach was wrong at it, but I just did not have success at getting to RIAs. I think unless BlackRock name was in the investment, that's kind of what most of these RIAs was saying, that why go to Talamar and their debt fund versus some big name debt funds that are out there. So we decided to kind of more focus on individual investors, high net worth investors, go more retail with our fund, and we've had a lot of success. And so I think we're going to continue to go down that path. I'm not saying it doesn't work. I've talked to a lot of other fund managers and have created great relationships with RIAs, and they've been able to do it. But I can tell you that from our standpoint, we didn't necessarily need to do it to get where we are today. And I would say with the amount of capital that's coming in right now, it isn't a high priority for us.
Yeah. Yeah, I've seen it's all over the map. There's some very specific things around that world. It depends on if you're dealing with broker dealers or RIAs. They're very, very different. There's a lot of things that you need to do in order to be able to even stand a chance to do it. Yeah. And to your point, Brock, I mean, a lot of them just they don't want to take a risk on things they've never heard of. Doing the due diligence is hard. If anybody has questions on that, I'm happy to take that offline. So,
and I would say the other thing, I mean, our average yield, I think for 2024, was about 9.5%. When you start to put in, what the fees are on some of these, companies that will help raise money for you, I mean, it's dropping the return to the investor to numbers that it wouldn't be very appealing for an investor to invest in.
Yeah, I mean, that's with RIAs, it's not so bad because they're already trying. I mean, you don't really have a lot of extra load, but if you're trying to run it through independent broker dealers, the load is just mortgage pool funds can't swallow that amount of a load. It's just too big, so it destroys the yield. So that also doesn't work. Here's another question: do you advertise to raise capital, and if so, what methods do you use? But yours is a 506c. Offering. People know what, for the benefit of people, that's you have an election to make in a Reg D fund. You can either advertise or not. Advertising requires you to verify the accreditation. That's something Verivest does on behalf of people, if they want it, or they can do it themselves. But you are advertising. Have you had much? I mean, you've obviously had success with YouTube. That's kind of been your number one thing, is social media.
So you bring up a good point. There's going to be a question early on: are you a 506B? Where you can take in non-accredited investors up to a certain amount, or do you just go accredited? We went with C. Again, that was another piece of advice that was given to me early on. I find that non-accredited investors are going to be the most difficult investors to work with. It's almost to a point where it's not worth bringing them into the fund. You're going to want to work with sophisticated investors who understand what your investment is and the risks involved in the investment, because you don't want your phone ringing off the hook when that article that came out in the Wall Street Journal about how home prices have peaked and they're coming back down. That's what I found. So I went with the C, only accredited investors. We've actually raised our minimum investment from 50,000 up to 100,000, and even considering raising it more at this point. But what was he? And I'm sorry, Matt, I went off on a tangent there.
Well, yeah, we were just talking about advertising and what's.
Advertising. Yeah.
Sounds like for you, it's been social media,
YouTube
especially.
Yeah, so YouTube, we have an email that goes out once a week to all of our investors to provide, updates on how the fund performance is, kind of highlight some of the loans that we've originated. We do a lot of fix and flip loans, so it's kind of fun to show some before and after videos of projects. But I think that, having a good email that goes out once a week, educating people not only on the fund, but on the industry is really helpful. And then find a mechanism or a way that you can find investors. So for the debt industry, for me, it's about people who invest in trust deeds. So I know there's a large number of individual investors that will invest in trust deeds, and we target those people and say, hey, here's another platform that you may want to consider. And it's a very effective strategy for us. But it happens, you've got to be out there on social media telling people about what you're doing. Again, not pitching them, just about what you're doing and why there's that opportunity that's there. And then sharing success stories is always really helpful.
Yeah. So I'll go with one more question before we wrap up, and this is kind of a deep one here, Brock, so see if you can dig deep and recall this, but it says, can you please recount your most profound moment of trepidation in your business since you started? And let's say in your fund business since you started, what did you do to
Trepidation. Good question. When I handed that check over to our law firm to start the to start the process of putting the fund formation documents together, I went into this. I feel like I went into it really educated. I felt like, okay, I've talked to a lot of people about every aspects of the fund. You know, running a fund, launching a fund. We already had all of our vendors chosen. I knew the process. But it wasn't just the physical money, but it was like, am I ready to do this? I mean, I knew I had the experience, but am I confident in my ability, from what I've learned, to be able to effectively manage a mortgage fund? Because the worst thing I'm thinking of is, obviously at the end of the day, is losing people's money because you've made bad decisions. You have to be willing to say, look, you're going to take losses. It's a risky investment, but did I make a poor decision in either planning or executing that resulted in the loss of investor capital? And that's what I really got concerned about when I handed that check. But I would never look back. I mean, it was the best decision by far that I ever made. And I've aligned myself with some really, really smart people and some really smart, I don't want to use the word vendors, that use partners that have really kind of made sure that we're successful.
Yeah. Well, Brock, it's been a pleasure having you, man. Always a pleasure. It's been good getting to know you more and more here this year. I look forward to spending some time with you at some of these upcoming conferences. Here's you see on the screen, here's how you can get a hold of Brock if anybody wants to chat with him about his experience. Here's how you can get a hold of me. Obviously, a lot of direct experience in setting up, running funds, administering, all the things that go along with it. It is a real business and it requires a real commitment to that business. It's not just a side thing. So I'd say don't view running a fund as just something you're going to do on the side as part of your bigger business. It needs to be really attended to. And I think Brock has done a fantastic job. So congrats on all your success, Brock. And thanks for being here today.
Well, and thanks for your team. I mean, you guys played a huge part in our success. You guys have a great team, and look forward to that new software rollout that you guys are having on the investor relations platform. We're excited.
Yes, indeed. We're looking forward to that too. And looking forward to seeing you get up to your 250 million or more. So congrats, man. Good chatting with you.
We'll get a round of golf together on that.
Yeah, for sure. Thanks everybody for being here. We'll see you guys next month. Thanks again.
Thank you.
Yeah.
Thanks, Matt.
Thanks, everyone.